Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Wednesday, January 15th, 2020. My name is Will Pauly and I'm here with my co-host, David Blake. David, how are you doing today?
Good, Will. Happy New Year, by the way.
Happy New Year. Let's get started with a peek at what the market's been doing with a look at the market letter. Can you give us a quick breakdown of what we're seeing here?
Yeah, okay. Last week, a little bit more volatility crept into the market. Investors shrugged off the little spat between Iran and the U.S., and then they continued to pile into equities. We did have an overnight 400-point drop in the Dow Jones futures on Tuesday after Iran took aim at some of the U.S. bases in Iraq. But by the time the market opened, we were back up to, I believe, even, and the market took off again, and we actually jumped about 373 points over that Wednesday and Thursday time period. So breaking out to new highs again. We did rally over 29,000 last week. We're solidly over that with the Dow this week. Mainly, we're getting the big cap technology names, which are feeding investor appetite for risk. The FANG stocks were broadly outpacing the broader market. You know, Apple, Alphabet, Facebook, they were all up about 5% for the week, and they're continuing higher this week. The leading sectors last week were communication services and technology. And also we had a little bit of a rebound in healthcare because we've had a couple of weeks of weakness in the biotech sector, our industry group, and that has held healthcare stocks back a little bit. And then we had weakness in energy and materials. A lot of that was due to unwinding bullish positions during the Iran spat. A lot of investors jumped into some of the oil stocks thinking that oil prices might jump up to around 70 or 75, and you don't see that. So several years ago, you've probably seen oil prices jump up to 80 or 85, and oil just isn't that as important as it used to be, and it doesn't have that big of a swing. And in fact, the United States is producing more. I think we're the biggest producer of oil in the world right now. So it's not these spats in the Middle East aren't having the same effect on crude that we used to get. So once it did spike up over 60, we did see the energy, oil come off of that pretty quick. Energy materials lagged the broader market. We did see gold jump also on that spat. We had actually. I believe it jumped up about $15.73 an ounce, which was the highest level we've seen gold since 2013, and it's since pulled back, but it hasn't pulled back a lot. Surprisingly, we're only down to around $15.45 or so, I think, yesterday. So it's gold seems to be still drifting, nudging a little bit higher. It might be something to look at on pullbacks in oil that you might be able to take a look at some of that. But anyway, we finished the period at or just below record highs. The Dow Jones snapped back from the previous week's loss. It picked up about 188 points, and the NASDAQ outperformed. It actually extended its weekly win streak to 5. It was up 1.8%, so outperforming the broader market. And we had a little bit of weakness in the small cap Russell 2000, which continues to show some negative divergence. At least it was. That was lower for a third consecutive week, though not much. Now, the technical condition of the market was little changed last week. It stayed bullish. Every dip so far continues to get bought. New highs, record highs were made with the Dow Jones, S&P 500, NASDAQ, and NASDAQ 100. Like I said, we did have some negative divergence showing up again in the Russell 2000, and that's continues to flash a little bit of a warning, but not much of one. We still have offsetting features of that. I continue to rank on the market about being overbought. Last week, I think the three big indexes we had, the fast stochastic in the high 90s. You don't normally see it get that overbought. In addition, we had for the NASDAQ, the 14-day RSI was at its highest level since January of 2018, which we're going to talk about here shortly. But that triggered a sell-off then. But I think the 14-day RSI for the NASDAQ up to about 81. Either Thursday or Friday, and back in January of 2018, we saw it actually get up to about 84. So we're close to being as extended as we have been. Finally, we saw the S&P 500. It was 9.6% above its 200-day moving average last week. We are at 10 point. I think we're at 10% or 10.4% right now with today's earlier move. Again, just very, very overextended. You don't normally see it that far away from the 200-day moving average. Internal breadth is still positive. The NYSE advanced decline line keeps making new highs. That's considered a leading indicator of market direction. The NASDAQ AD line, though, has slowed significantly and is showing less and less participation to the upside. In fact, the last couple of weeks of this 6-day or 6-week win streak, you're only seeing the AD line for the NASDAQ pick up maybe anywhere from 250 to 500 units per week, where the Dow was, or the NYSE was actually picking up, close to 1,500, 2,000, 2,500. So that's another red flag there, the NASDAQ AD line. It's just showing that a lot of these gains are being made by the FANG stocks, again, which we would like to see a broader participation in that. Okay, lastly, we have some sentiment is also showing that investors are still too bullish, a little bit too complacent. That doesn't necessarily signal a market top, but again, it's just another red flag that I'm looking at to go along with the negative CTI. One thing I wanted to mention is we got our phase 1 trade deal signed today. We're having the market rallying up on that. But still, when you see a market that like the S&P 500, it's up 15, 16, 17% off of the October low. The NASDAQ is up over 20% off of that same time period. Things just don't go straight up forever. I've been saying that I'm looking for some kind of a pullback to buy the market. It doesn't mean I'm aggressively trying to sell stocks. I said in the last week's letter that I don't see a reason to aggressively sell stocks here, but it would be wise probably to tighten up your stops. And also, as far as committing new money to the market, I would wait for a little bit of a pullback and let my winners ride up here. So that's where we are right now. Everything looks good. We are, like I say, overbought. The market is susceptible to lower prices, and I think that if you do start to see some selling, a lot of traders or a lot of hedge funds and that type of thing are going to lock in some profits because they it's gone up so fast.
Thanks, David. Let's move on to the market recap and look at some of these internal breadth indicators.
As you can see down here, on the left here is with the AD line on the NYSE. Again, it just keeps on going higher and higher and higher. That's a bullish sign. It means you're seeing a lot of broader participation there. But over here in the NASDAQ, which we talk about the negative divergence with the small caps. Since the end of December, this thing's just kind of going sideways, and that's negative divergence on that. And part of that reason is because you're seeing the big advance in Apple and Alphabet, the old Google and Facebook. These are holding the NASDAQ up. Now today the NASDAQ's up again, but you're seeing the Philadelphia Semiconductor Index down. I think it was down 1.6%, and it's it last made a new high. I think it made a new high yesterday, but we're starting to see some more volatility in the semis. Now, often what technicians will tell you when you're close to a top or close to a bottom, you'll see volatility really start to pick up. You'll see these big swings of 200 and 300 point days at the top, and that's another flag that's saying, hey, we are near a top, short-term top in here. These volatility swings where we're having 300 points, where like yesterday we were up 150 points, and then all of a sudden they talked that the tariffs weren't going to come off, and we saw the market pull back. The Dow erased that 150 point gain. Now the reason that was, and some people would say, well, why would we, just because we're leaving tariffs on, how is that going to affect the trade deal? A lot of companies still see with the tariffs that were already on there, it does cause, especially for some of the smaller caps, it causes some of their materials and some of their importing costs to go up, which means they have to raise their prices on stuff, costs them more to make, and that has caused a lot of slowing in the third and fourth quarter of last year, and that just means that perhaps we may not see the growth acceleration in earnings due to material costs if those tariffs stay on. So even though it didn't seem like much and no one had talked about it before, that was a little bit of a big deal. Now, if we go down here a little bit further, we'll see here on the new highs on the NYC and NASDAQ, this actually is bullish. We had the negative divergence on the AD line in NASDAQ, but now we're starting to see more stocks make new highs and new lows, which is bullish. Of course, when you get this far, when you're making new records for this long, you do have more stocks up to the high. But this expansion in new high versus new lows is solid for the market. That's another indication that you don't want to be out here just selling anything. Lastly, we have the VIX hanging out down here around 12. That just means that traders aren't too worried right now. They believe that the market can work its way higher from here, and it's very possible. Like I said, I'm not committing new funds to this market right here, but I do have some stocks that I would like to buy, possibly on a pullback.
All right, thanks, David. You've been cautious about this market in saying you're expecting a pullback, but so far we aren't seeing any weakness. Do you think we're still due for a pullback soon, or has your position on this shifted?
No, I do think that we'll probably see some selling on here. I'd like to refer to the charts over here just for a minute. I'm going to pull up the S&P 500 if you can put S&P in there. Okay, I'm going to expand this out a little bit. This market really reminds me, going back here to 2000, the end of 2017, where we had this almost a parabolic rise in the market going into January of 2018. A lot of similarities. What was going on back here? People thought the market was getting toppy right in here, and then all of a sudden we got the big surge on expectations for tax cuts, and that happened, and we ran up into that, and everyone would say, okay, we got the tax cuts, that's going to be great for earnings, and it was great for earnings. However, we just got overbought. I was reading some of the old weekly market letters, and we talked about the technical indicators are all bullish. They're confirming the move higher. The Russell back then, it was once again showing some negative divergence. It couldn't keep up with the broader market. The Philadelphia Semiconductor Index had stalled a little bit, but it started to take off too. And then I looked at the S&P, how far it extended past the 200-day moving average. It actually got up to 13%, which is almost unheard of. And then on January 26th, things were going so great, and the market was going to go to the moon. And then the economic news was so good that all of a sudden the Fed came out of the blue and said, "Well, things are going so great, we may not be so. We may start to maybe have to raise rates." I don't see that happening at all. But generally, when it gets this bullish and the market starts to take off like this, you can start to see possibly some inflationary data start to cross the wires. It hasn't happened yet, but that's something to look for. Or maybe perhaps the U.S. dollar begins to strengthen. Right now, we've seen a nice pullback in the dollar, which is also helpful and supportive of the market in here. But you do want to make sure that we don't, that it's not just completely risk on. It doesn't stay risk on forever. Now, which is strange about this part of here. Last time, as we started to make these new highs back here in 2018 in January, we were starting to talk possibly about maybe when they started to bring up the interest rates could go up. You saw the utilities and the REITs, consumer staples, those interest-sensitive group rates really took a hit. Now we have the utility sector right now, the Dow Jones Utility Index actually making a new high here. So that's telling you that traders and investors aren't looking for rates to begin to move up. The only thing that would change that would be some kind of inflationary news. But A lot of similarities to then and now as far as the technical shape of the market. The volatility again started to shift up. We were getting 200 and 300 point days, but back then interest rates went from about 2.5 up to about 2.85. So we were pushing close to that 3%, which got everybody worried before we backed off. So I do want you to take a look at that. Again, it's something goes until it goes. And at this point, I don't see reasons to be taking profits. You do want to keep your eye on maybe the Philadelphia Semiconductor Index. Also keep an eye on the transports and the small caps. So today the small caps are actually outperforming, and we got some good earnings from Delta yesterday, which helped the Dow Jones Transportation Index almost punch a new high. We're about 200 or 300 points away from that. We get some more earnings on that. We might see that go. But you'd like to see the Russell 2000 get up above 1600. That would be good. Someone says, how come we have a minus CTI? I explained this. Actually, I saw this in one of our old tech talks from back then. Just because we have a negative CTI doesn't mean the market can't continue to go up. The CTI measures different cycles in the market, and it's kind of based on what it means is when we go negative, if it's not outright weakness in the market, what happens is at least you should have some slowing down in the business cycle. And I think actually we probably the trade deal's given us a nice big boost, just like the tax cuts gave us a big boost back then. But as we see things start to go into the earnings, the bar's set low. We're getting decent earnings right in here, but as we go forward here, if we start to see that companies are saying, well, because of the tariffs are still on, or it's taking too long to get this trade deal done, first quarter is not going to be as strong as we hope for, then you'll see the market pull back. At this stage, we're expecting fourth quarter to show a loss of anywhere from about minus 0.6% to minus 1.5%. That'll be the fourth quarter in a row where we've had negative earnings. And the market and the analysts are expecting to see earnings pick up pretty solidly here starting in the first quarter. I think we're expected at 3.5% to 4% and going up to about 6% growth year over year in the second quarter. So we do have we can. I would buy the dips in here. I do still think that any kind of little hiccup when you're this stretched, you see things move too far to the upside. You can also see things move too far to the downside. And should we get some kind of little hiccup in the market with some weak data or something like that, I think you'll see the market move further to the downside than what you would expect, and I think that will represent a pretty good buying opportunity. Okay, one last thing before I wrap this up, I want to go over to StockWatch. I pull in here. As I look at the sectors a lot to see where the market is expanding, what seems to be the strongest and weakest. And I want you to take a look at this. And we see this, we're talking about the market punching new highs. It's almost having a parabolic move. But then when you come over and look at the individual sectors, you only have 3 sectors that are actually outperforming the broader market, the S&P 500. That's tech and communication services, which includes Google and Facebook. Of course, the tech sector, you have your Apple, which is going crazy, NVIDIA and that. So, their power ratings up here around 80. The healthcare, just in the last week or so, it was pretty strong. Biotech has bounced back, which has helped it coming up here. So it's only just barely beating the S&P 500. But you get down here and you see all these other industries are still underperforming the S&P 500. And again, that shows you the narrowness of this parabolic move in the market, which is not a healthy sign. Ideally, when you're sitting here punching out new highs, you would like to see 6 or 7 or 8 of the 11 sectors beating them. Just broad-based strength behind them, and you're not seeing that. So again, that's just another sign that you want to be a little bit cautious in here.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer on the next Tuesday Tech Talk, You can email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tech Talk. Thank you for tuning in, and we'll see you next week.